start. I have all my notes here. Okay, I think I want to take it off because it's a little bit. It's okay.
Yes. Yes.
It was for the first impression. Well, thank you for coming here. First of all, I want to say thank you to Annette Admani. She's my thesis advisor, the writer of this book. I recommend it. And she's finishing the new one.
No, not yet.
Yeah. Okay. Also, I want to thank my wife. I couldn't be doing this without her support and all of her. So, let's start. First of all, why am I talking about this not very fancy title, Analysis of Banking Regulation and Policy Recommendations for Chile? Because when I met Professor Admani last year, actually it was this year, when I asked her about helping me in my thesis, first I was thinking about fintechs in Chile, something very cool. And then she said okay, and she gave me this book. And I read this book and I said, oh, this is actually what I should focus on. This is much more important. All the other stuff are cool and they're gonna come to Chile no matter what, but this is something very important and nobody's taking enough care about this issue. So I decided to do some research about banking regulation, about capital regulation, and how we can apply this to my country. Okay. So first, I want to start with something more fun. Who likes to gamble here? Okay. I know my wife. Okay. That's the deal. There's a nice house in the neighborhood that has a price of $100,000, but you have only $1,000.
Not in this neighborhood.
Let's say in, I don't know, even East Palo Alto, no, now it's very expensive. Yeah, whatever. Okay, but there's a bank willing to loan you $99,000 in a mortgage. Only two things can happen tomorrow. Or the house's price goes up 20% or it goes down 20%. We're going to say that with similar problems. Would you buy it? Remember that you can always decide to stop paying your mortgage, but the bank keeps the house, it's a foreclosure, but you only lose the down payment of $1,000. So would you buy it? Would you do it? Who would buy it? Definitely. Yeah, sure. Okay. It's not a gamble, it's a safe bet, by the way. We're going to see. Okay, so that's the situation. We have the house. We're going to call this the asset. It has a value of $100,000. And we are financing this asset with $1,000, which is the down payment, which we are going to call the equity, 100% of the value, and the rest is debt, 99%. So we are now in the positive scenario. The price goes up, so you are happy. The value of the house is $120. You still owe $99,000, but now your equity is much higher. Now you have an equity of 21. You're making $20,000. So your return is $20,000 out of an investment of $1,000. So this is a very nice return of 2,000%. Okay. Well, what if price goes down? The same initial situation, but now the price goes down to $80,000. So now you lose your house. You're going to stop paying the debt, the mortgage, because it's not worth it to have a mortgage with a price, a mortgage when the price of the house is lower than the value of your debt. So you just go back to the bank saying, you know what? Here are the keys of my house. The bank is going to sell the house. They're going to make a loss. But your return, you lose only $1,000. You invested $1,000. It's a 100% return. Negative. So your expected value of this bet is 50%, probability of price going up, times $20,000, plus 50% times minus $1,000, which is the situation where you lose. So the expected value is very good, $9,500. It's really a safe bet. And even if you were risk neutral, you would be willing to accept this deal, even though the probability of the price going up is as small as 4.76% and the probability of the price going down as high as 95%. In that case, you have an expected value of 0. Actually, this is what happens in very distressed companies. When your equity is very small, actually you don't care very much about the downside of the investment, you care about the upside. So this is what happened in companies that are very close to situations of bankruptcy. This is one of the typical risks of distress. So now let's set a more realistic case. Now what it's gonna, by the way, now what is gonna lend you 99% of the value of a house. A more realistic scenario would be that one. By the way, in the US, if you want to buy a house with a mortgage, if your down payment is lower than 20%, you have to hire what's called a private mortgage insurance, which of course costs money. So the lower the down payment, the higher the private mortgage insurance that you have to pay. So in this scenario, if the price goes up, again, you still owe $80,000, but now your equity is $40,000. Your investment, you still are making $20,000, but over an investment of $20,000, this is a 100% return. It's good. It's not as fantastic as in the previous case, but it's a good return. And if the price goes down, same situation. Now you lose all your capital, all your equity. The bank here know that the bank is not making a loss here, because what you owe is exactly the value of the house. So your return here is also minus 100%. So the expected value here is 0, because what you win is what you lose. This is what Warren Buffett calls, now you have skin in the game, and you're going to be more careful in your investment decision. Okay? So what we have done is just to set the typical financial structure of any firm. You have assets, any corporation, any firm has assets, and you have to fund these assets with liabilities. And you can fund these assets with any combination between debt or equity. So we're going to call the equity over assets ratio. This is the way how the assets are financed with equity. It's a measurement of capitalization of a firm. We're going to call insolvency a situation where the value of the assets is lower than the value of the debt. And of course, when you have a higher equity over assets ratio, you have a higher ability to absorb losses with your equity. So the company is more solvent. So remember that equity is like a cushion. So whenever the company or you have a loss or the value of the assets go down, you have to pay the debt no matter what. So the equity will absorb the loss. So in this case, for instance, you're losing money, the assets are shrinking, you still have to pay the debt, your equity is lower. Let's say you make another loss, now you still are solvent because you are honoring your debt. You can be in these extreme situations, you are still in the limit of being insolvent. So here, you're in a very, very risky situation. This is very close to the previous case when you're close, your payment is only 1%. So any tiny reduction in the value of assets could send you to bankruptcy. And now, and here, you're done. So, let's talk a little bit about banks. What is a bank? A bank is just as any firm, but as a specific business. They basically receive deposits and make loans. They do other things, but we're going to focus on their main business, which is receiving deposits and making loans. The typical financial structure, and this is a simplification. We have on one side liabilities. Banks receive deposits from you. Whenever you go to the bank, you make a deposit. This is your asset, but it's the bank's liability. The banks can also receive other kind of debt, and they have some equity, which is the money or the capital that owners put into the business. And with all this funding, they make loans, but they also have to keep some reserves on their vaults, because you know if you are a depositor, it means you can go to the bank and withdraw with no notice. I mean, with no any announcement to the bank. if you need some money, you don't call the bank, hey, I'm going tomorrow to withdraw $500. You just show up, and the bank has to pay you upfront. If not, the bank will be in trouble. So the banks, of course, they keep some fraction of their deposits in reserves. What are the bank's risks? Banks are subject to many risks like interest rate, exchange rate, inflation, country risk, operational risk. All those risks also are applied to any other kind of firm. There are two specific risks that are very important for banks. The first one is liquidity risk. Liquidity risk occurs when the bank has not enough reserve to respond to deposit demand. Let's say all the depositors go at the same time to the bank to withdraw, the bank will not be able to pay them because part of the deposits are invested in loans and most loans are illiquid. So this is what some people call a run, or it's an extreme situation of liquidity risk. The other risk is insolvency risk. Actually, it's related to the previous one. Insolvency occurs when the total value of the assets are not enough to satisfy the value of the debt. Okay? A lot of runs occur because people, depositors, have doubts or have concerns about the real solvency of the bank. So this is, when you have concerns about the solvency of your bank, you're going to go and withdraw the money and going to invest it into another bank, of course. So insolvency and liquidity risk are very related. So let's compare now the typical equity over asset ratio for banks versus non-financial companies. Here's the average of equity over assets ratio for the last year for main companies in the United States and main companies in Europe. The averages are very similar, 36%.
Probably as you talk about all these numbers, you want to just mention that there's accounting issues and sort of measurements about who puts the numbers. So, and even for value of the debt, you really care about what's called the face value, that in other words what you owe and not what it's worth in markets, actually on the value, because you still owe it. But especially for equity, for non-financials, oftentimes the market value of the equity is much higher than the accounting value. So anyway, so you could have very low sort of balance sheet accounting value, but there's really a lot of equity markets that they, are not indebted at all, that damage at all. Many of them you wouldn't even see it in accounting.
Yeah,
banks is the other way around. They often have low market value relative to accounting values. So.
Well, and this is the average of equity over asset ratio for US banks and European banks. 10% for US banks and 5.8% for European banks. And this is last year. In the year 2006, we're going to see just before the mortgage subprime mortgage crisis, the ratios were even lower.
Just out of curiosity, are these weighted average and regular? Or
this is weighted.
This is weighted.
Weighted. It's not arithmetic. It's weighted average.
So you mean with risk weights? Or no?
No.
Just weighted average for, I'm trying to think about big versus small banks.
Okay, but, and also the other thing is sort of off balance sheet, all kinds
Yeah. No, but this is weighted in the same. Big banks have a higher weight in the average. That's why it's not an arithmetic average. Okay.
Value weight.
Yes.
Yeah, just going back to what the professor was saying, is the implication is that the gap between those two could be smaller?
It's worse. It's worse because they have much more equity than they appear, and the banks have much less equity than they appear.
Okay. If it's
so this is not as extreme as it actually is.
Yeah.
The difference is very extreme.
This is book value.
Yeah.
Because
So the book value or
so that's not the market cap.
Yeah.
No, it's
the
not market cap.
cap would be much
No,
larger.
the market capital is even.
Therefore, more equity.
Yeah.
Gotcha. Got it.
Okay. This is just to show you an example of U.S. companies. This is the average equity over assets ratio. So most companies, the average is about 38%. This is the average of the last 5 years. You can see, I don't know if I can use this as a Okay.
Yeah.
You can see that most companies are over 20%. Okay. So we have a few companies here, mostly technological companies. This is Google, 9%. No, sorry, this is Facebook. This is Google. This is, I think this is NVIDIA, Intel. So most technological companies are here. And a few companies are here. I think this is Boeing, some tobacco companies, UPS was here. But in general, companies are very well capitalized, you can see. And here we have the average for the largest American banks. The average is about 10%. And the range goes from 6 to 13, 14%. So it's, you can see how low the equity ratio is for banks compared to other companies. Okay. The situation has been stable during the last 20 years. This is this is banks for the US. Those are right. So we have the banks in the US between 5 and 10%. The banks in Europe around 5%, and non-financial corporations in both. Well, why do banks hold so low equity ratios? That's one question that you probably have so far. There's one main explanation for that, and it's because of explicit and implicit subsidies from governments. One explicit subsidy are the deposit insurance, which are usually underpriced. Even though banks have to pay for this insurance, usually the price they pay is much lower than the real cost of these insurances. So what happens when you have deposit insurance? Depositors then have no incentive to monitor the bank's financial health. Why? Because if you think, or if you believe that somebody's going to pay you no matter what, then, okay, you just relax and you trust into the bank. Deposit insurance were established after the Great Depression in 1935 because it was a very efficient way to avoid runs. Runs are very costly and very inefficient, so when you have deposit insurance, at least you reduce the probability of having a run in a bank, which is good. The problem is that it generates this moral hazard when depositors have no interest or incentive to monitor the bank.
So do other banks have incentives? They have some incentives to monitor each other because their insurance payments go up.
Sorry?
The insurance payments go up. If you're a bank and I'm a bank, if you're riskier, then I have to pay higher insurance.
Well,
so there should be some incentive to cross monitor.
The problem is that the insurance has to be paid to the government. So
right, but
the government should increase the price, but it doesn't.
Well, because I think it's totally funded by these payments. So if there's a bank that goes bankrupt, then the payments for other banks goes up.
But there's no way to actually affect each other's.
Well, they can put pressure on the regulator.
Well, the fact of the matter is each one of them wants to have as little equity as possible.
Yeah.
But the problem is that they can, that's the point. You know, without the regulators, it's basically like the regulator would be what would normally be a debt covenant. In other words, if you have unsecured creditors with no collateral, like deposits, they would, if they were not insured, they would be very harsh in terms of conditions and monitoring.
Yeah.
Because they're at the bottom of the barrel and they can always be taken advantage of, right? These are particularly passive creditors.
And the other subsidy is more implicit, are the bailouts. Also the too big to fail problem.
Again, sometimes it's not on one bank, it's just like the whole system. So it flows from, you know, you bail out AIG, you bail out the banks that took risk with AIG. So the bailout flow to the creditors or whoever is bailing out.
So the things that with bailouts, and it was very clear during the last crisis, when the government decided to bail out companies because they were too big to fail, I think it was maybe the only thing to do. I mean, once you are there, there's nothing else you can do because you don't want to destroy the whole system. The question is, why did we get there? Okay. So the problem is that when there are bailouts, and it happened also in Chile in 1982, 1983, there is and there's memory. So if you know that the government did bail you out in the past, you think that maybe it will bail you out again in the future. So again, it generates, can create moral hazard. So, in fact, before those subsidies were in place, we're talking about the beginning of the 20th century, the equity ratios were close to 20 or 30%, much higher than now. Well, you could ask, what is the problem behind low capitalization in banking? You wanted to ask that?
Yeah, could you go back to the last slide? Just about this issue about moral hazard as it relates to sort of deposit insurance. I mean, when you're thinking about like the head of a JP Morgan or CEO, like the individual who's sort of calling the shots in terms of increasing the risk appetite of a bank in the run-up to into a crisis, so sort of taking on subprime, is it really that he's thinking, you know, well, I'm not going to suffer the consequences, the bank is not going to suffer the consequences, or is it more, could it be just more psychologically on an individual level, like, well, I'm not going to go to jail for that. But that's a different type of moral hazard, if it makes sense. I mean, that's systemic. I'm just wondering what causes the decision. I mean, if I was Jamie Dimon, I'm not thinking, I don't know if it's necessarily like, well, you know, I'll take on no risk because, well, the bank will. I think he's maybe thinking about his individual incentives as much as well.
The moral hazard occurs because under this situation, the bank has an incentive to have higher debt, a lot of deposits. And when you have a lot of deposits, it's like the situation of the house. You have a very low equity, so you benefit from the upside. So you could go for riskier bets. That's the moral hazard. So very low capitalized companies increase the risk for the managers or the owners to go into for more riskier investments that maybe are good for them, but are not good for society and are not good for the creditors. Of course.
The way they're compensated often is exactly encourages that, because they're compensated by return on equity, which is the sort of the 2,000% equity.
Yeah.
And the kind of return, they measure returns independent of risk, which of course means that the more risk, the more return.
So the next question is, I think this is one of the most important questions here. What is the problem behind low capitalization in banking? Because you could say, hey, banks are different. Banks, they're in a different business. There's no problem for banks to have low capital or low equity ratios. Well, the problem is that, as we already mentioned at the beginning of my presentation, any significant loss or reduction in the value of assets could generate distress or insolvency when your equity is very low. And also, if massive banking distress or insolvency occurs, the domino effect can destabilize the economy, destabilize the economy because of the interconnection between the financial sector and the rest of the economy. So, and actually there's a study by Reinhardt and Rogoff that showed that during the last 800 years, most loan crises were associated to bank crisis. Well, let's talk about the mortgage subprime crisis of 2007 and 2009. Here's a graph of the house prices of the US for the last almost 40 years. You can see that the price were going up, down, and then we have like 20 years of up, until this year here, 2006. And then suddenly something happened. I'm not going to talk about that, but the thing is that in 1 year, the average price, this is the average price, went down 6%. Some houses were going down like 50%. Whole neighborhoods were going down in terms of price. Next year, 7% down. Next year, 8%, 6%, 7%, 5 consecutive years. And this is the residential mortgage-backed securities issued in the United States. A mortgage-backed security, or MBS, it's a financial asset that group mortgages, individual mortgages, in a package. So you can sell a fraction of this security to investors, to people, to investors, to other banks. There are some companies like Freddie Fannie Mae and Freddie Mac, that they buy those mortgages, they build up these securities, and then they sell them again in order to provide liquidity to the market. So you can see that in year 2007, 6 and 7, the total value of all of these securities backed by mortgages were about 3 trillion. This is about 20% of the GDP of the US. So all the securities that were backed by mortgages, of course, had a high correlation with the price of mortgages. So whenever the price of the house went down 5%, 10%, 20%, happened what I showed you in the first slide. People decided to stop paying their mortgages, and the value of all the securities were going down and down and down. And all the securities were held by banks in the US and in the world, especially in Europe. So this is why all this situation was like an international disease that spread out very, very quickly. Okay? So it looks very similar to this situation here. Okay? So let's talk about international banking regulation. So this is something not very new. This is Basel in Switzerland, very nice, beautiful city. In 1974, the G10 decided to found this called Basel Committee in order to enhance financial stability by improving the quality of banking supervision worldwide. Okay? So Basel, in 1988, after some debt crisis in Latin America, decided to release their first document called Basel I. It was the first international attempt to establish minimum capital requirements. So here we have the typical financial structure of a bank. So we have assets and we have liabilities. We talked about the equity and asset ratio. This, what we measure the capitalization of a bank. However, what we would have expected is that Basel would have said, hey, let's set a minimum equity over assets ratio requirement, higher than the current average that we have. By the way, in 1990, the typical bank in Europe had an equity over asset ratio about 3%, and it didn't change very much after that. But instead of doing that, they said, you know what, maybe we can look for some kind of debt that are not equity, but they look like equity. So let's be more generous with equity. So don't talk anymore about equity, let's talk about regulatory capital, a very fancy word. So they say, okay, forget about equity, now we're going to consider regulatory capital, which is equity plus other debt, which is debt, but looks like equity. And then they said, you know what, maybe not all the assets need to be backed up by equity. There are some assets that are very secure, like, of course, cash, but also some bonds issued by Greece, or by Spain, or by Italy. And that's true. And they said, those bonds have zero risk, have no risk, so you don't need any capital to back up those assets. So let's talk about something different. We're going to come up with this idea called risk-weighted assets. Okay? And this is what is known as Basel ratio. And they said, okay, we have invented this capital ratio, and we are going to set it at 8%. Of course, 8% sounds much better than 3%. Sounds like, oh, we are very well capitalized. So technically, the Basel ratio is regulatory capital over the risk-weighted assets. I don't want to spend too much time here, but actually what they do is, okay, take all the assets and multiply them by a weight. So any bond issued by Greece or Portugal, don't worry, multiply by zero, has zero risk. And mortgages have 50% risk. Banks of OECD countries, 20%, and so on. Okay.
So in this ratio, you kind of diminish the numerator and the denominator, so it's not...
We are increasing,
Increasing the
we are
denominator.
here,
You include more things in the.
we are increasing a little bit the
see. And you're
numerator,
decreasing
and we are, so the ratio is very generous, it's very generous. Okay, so I'm gonna show you how what's the equivalent between the Basel ratios and the real equity over assets ratio. Okay.
They actually had no requirement of equity over total
Yeah.
at all the way
Exactly.
to now, where it's 3.
Okay, then came 2004, Basel II. They said, okay, let's do something. So actually they didn't do very much. They just changed the way banks can calculate their risk-weighted assets. So they said, you know what? You can use your internal models. So actually it was even worse because now banks could use their own models, and actually their risk-weighted assets went down.
When the assets went up.
When the real assets were going up. And the other point was that because of that, banks were, they say, okay, we have to comply with Basel. So if I have to make, I can make a loan, but because of Basel, I need 100% of capital for that. But if I buy a mortgage secured, a mortgage-backed security for some guy who bought a house in Illinois, and maybe he's a ninja, but I don't know because it has AAA, I will buy it, and Basel allows me to only back up 50% or less of the value. Yeah. Or the same with a bond from Greece, 0%. So actually this increased the risk of banks. Yes. Then the subprime crisis came, and after that Basel Committee decided to do something else and to move a little bit more. So they came up with, they decided to increase the Basel ratio from 8 to 10.5%. It's not a huge increase, but it's something. And then they incorporated for the first time what they called the leverage ratio. But still, they didn't want to accept, to say, hey, let's do an equity over assets ratio. They still use those difficult words like tier 1 over total exposure. But it's very close to what I've been talking about. It's very close to the equity over assets ratio. And they set it again in 3%. They could have set it in 5, 6, 7, whatever, but again, 3%. Okay? So this is interesting. I did a simulation of the average, the typical US and the European bank. So I said, okay, under Basel I, this 8% of capital requirement is equivalent to what in terms of equity over assets ratio? Remember that Europe and the US, they use different accounting rules, so there could be some differences. So for Europe, this is equivalent to an equity ratio of 2.5%. For the USA, for about 5%. Then we have Basel III, which increased the Basel ratio from 8 to 10.5%. So in Europe, this is equivalent to 3.3%, and for the US banks, it's equivalent to 6.5%.